Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to another one of our Wednesday webinars. My name is stockdarts, and as usual, we're going to go ahead and take a look at the major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish that, we are going to take a quick look at the US dollar, see how it's affecting gold and silver, and see how oil's behaving as well. And once we finish that, we'll move on to the chart requests. Those of you that are in here now, if you have any chart requests that you're hoping to see, feel free to put it in the chat. Just type it in, and that way I can see the tickers and get a general idea of how much time to allot to that. You can follow me at stockdarts on Twitter, stockdarts on YouTube, or visit me at patreon.com/stockdarts if you like the analysis that we do here. You like my way of looking at charts. There's plenty of other content available for you if you just go to any one of those links. Other than that, let's go ahead and get started with a look at the S&P 500. Now, for those of you that were here last week, you'll know that we were looking at the market and saying there's a pretty decent chance that we are going to push towards all-time highs. It was a pretty nice breakout. Once we were able to kind of confirm this 280 level as support and push past it. And that's so far what's happened is we've just been sort of really inching our way upwards. You'll notice that momentum has died down, right? We didn't zoom up to all-time highs, but you can see we're not finding any sellers. We're just really pushing upwards little by little. And I think at this point, the momentum's starting to wane, and it looks like we might need to consolidate a little bit more. But I think ultimately that's still what the market wants, is to test those all-time highs, particularly on SPY and the Qs, the NASDAQ Composite. The Dow Jones and the Russell 2000 are lagging behind and have encountered more sellers, but I think overall the market is still pretty healthy and still doing a pretty decent job of trying to explore higher and really figure out exactly where the sellers are. I think all year what we've done is really just climb higher and higher, looking to find sellers, and we've only encountered a batch of selling twice, really, and both times was really right around that 280 level. And for the most part, it was just 2 or 3 days of selling, which was immediately responded to by the buyers stepping in and pushing the market right back through that key level. So that's what it looks like. Looks like we want to head towards 290, 292, 293, somewhere in that area. And the question now becomes, do we do that this week, or is it going to take another week? And I think that there's a decent chance, just based off of how we spent this last week trying to climb higher and not really pushing it, that we probably need to pull back a little and test maybe our moving averages, maybe test this ascending trend line, basically just test the short-term sentiment before we really push towards all-time highs. If you were just look at what's been going on here, and you can see the shape of price action over the last month and a half now, then it's starting to slow down a bit, right? And I think at this point we need another test of this ascending trend line and another test of really just short-term sentiment. And at that point we might have finally the momentum we need to push us back up towards the 290s. Overall, I think the market's still pretty healthy. I will say this, the same thing I said last week. I think risk-reward is not that great right now. I think the closer and closer we get to all-time highs, the worse risk-reward gets. And despite the fact that I think the market's in great shape right now as far as whether it's bullish or bearish, I think we've reached a point where it's difficult to trust the market from a risk-reward perspective in order to go ahead and get too involved in it, too heavily invested. I think at this point we want to be pretty careful and not necessarily flip to bearish or too distrustful of this market. Just wait for better opportunities as far as risk reward is concerned and as far as getting higher probability setups than we're getting right now. I think the setups that we have right now are really not that appealing for me as far as trying to get too invested and trade too strongly to the upside. That said, I don't really want to short the market or trade to the downside because I don't think the sellers have had an impact all year. If you step back and just go all the way back to 2019 and just look at what we've done this year, there really hasn't been any sort of impact from sellers. And I think it's kind of a trap to tell yourself, well, we're getting so high up, the sellers are going to come in now. That doesn't always happen, right? And even when it does happen, it doesn't always happen when you want. So this idea of always, sort of just playing the highs and saying, well, the higher we get, the more chances we get to see it drop. And it's almost like you're playing the roulette wheel, right? Where you're telling yourself, well, black has come out 5 times in a row, red is due, and that's not the way the market works. It's not the way the roulette wheel works, right? Every single time there's a 50% chance, well, 48% or so. And with the market, it's sort of the same thing, where just because it keeps going up doesn't mean that it's due, quote unquote, to go down. So not too excited about it right now as far as shorting it. Not too excited about playing to the long side. So where does that leave us, really, right? Well, I think we're in a bit of a stock pickers market where I'm still trading to the long side, but I'm being a little bit more careful about what I'm choosing. And I'm sticking to the areas of strength, and I'm sticking to the areas that have good risk reward and maybe aren't as strongly correlated to the markets. For instance, last week, and I'll go into this, I guess, in a little bit more detail once we go through our general analysis, but the last couple of weeks I've been recommending either trading tech names, which of course are correlated to the market, but it's where the strength is, or oil names. And oil names have done pretty well for us and have had some nice moves that aren't necessarily that strongly correlated to what the market's doing, because oil has been lagging for a while, but only recently has been picking up some nice steam, and there have been some nice names related to that sector that have moved well. And that's kind of the way you want to play the market right now, is you want to sort of pick and choose and look for pockets of strength, or look for areas that aren't as extended, I guess, or overbought as the market is. Now, that being said, there are two key factors that could affect us as the market heads into the rest of this week. And one of them is we have FOMC minutes today. FOMC minutes aren't quite as impactful as the FOMC meeting, but you never know. Sometimes people could glean some sort of little bit of information off of there, and it could impact markets in the short term, not necessarily in the long term. The other thing we have is we have earnings season pretty much set to kick off tomorrow. If you come over here and take a look at options time, you can see we've got JP Morgan and Wells Fargo reporting tomorrow, and we're going to have a much bigger list of names reporting next week. And once that comes into play, then it adds, obviously, a new factor into whether we're ready to push higher and test all-time highs, or whether we're going to finally pull back and really find some sellers and finally test the buyers, which have not been tested all year. I always point this out. If you are trading, if you're a swing trader, always double check whether you use Option Slam, whether you use Earnings Whispers, or any of these other sites. Even if you just use Yahoo or Google Finance, always double check the earnings report date of any name you're going to trade. If you're a swing trader, more likely than not, like myself, you're using technical analysis, trading based off of chart patterns. And those can get totally violated and ignored during an earnings event. And there are a lot of names that can move a good 15-20% during their earnings report. And if you don't account for that volatility, then you might put yourself in a situation where you end up taking on way more risk than you anticipated as a trader. It could go in your favor, but there's just as much chance that it goes against you. And I think as a trader, you want to make sure that you eliminate as much volatility or variability to your trading as you can. And earnings season is a good way of introducing extra risk that you may or may not want. That doesn't mean you shouldn't trade earnings season. I trade earnings season every year, every quarter, and enjoy it very much and do very well with it, but using a system that is very different, that trades off of volatility and uses options to limit risk, and does a real good job of being able to predict movement, not necessarily direction, but overall movement in names. If any of you guys have any interest in that, you can always ask me. You can either message me on Discord, you can email me, or just ask me on Twitter, and I'll give you some more information on how I do that. And if you'd like to join me, if you head onto the Patreon page, you can click on one of the subscriptions there to join me for the quarter. But for the most part, if you're looking to trade just directionally, you're better off just avoiding earnings names, and that's going to be something that's going to help you in the long run, is to control your risk by either understanding how to limit risk with options or just avoid the volatility altogether, because it's really kind of a crapshoot as to what's going to happen once you do go ahead and trade it. Now, like I said before, earnings can impact the market, and we're going to see now as we head into the next 2 weeks what the tone of reports are, whether these names continue to anticipate a slowdown or increase in business, and that will have an effect on the markets. But other than that, we're still kind of trading off of technicals, and until we see the tone of earnings, we can just assume that we're going to continue to trade off of what we're doing here. So what are the key levels here? What can we anticipate here on the S&P 500, particularly from here to next week, as we are only starting to get into earnings season? Well, like I mentioned earlier, you can see that we're just kind of trading up in something of a wedge / channel. And I think at this point, it's probably more likely that we come back and test the 20 period in the bottom of this wedge, continue to climb higher all the way up to the new all-time highs. And that's what I would anticipate. But at the same time, until we see that pullback, I think we can also just wait and see how it consolidates. It's like I said, you can see we're trading very narrow days, slowly consolidating, showing that there's very little impact from the sellers, and buyers continue to pile in. When you see something like this, particularly what you see in the last several days, right? So if we even just zoom in like this, right? When you see this price action in particular, what it's showing you is that buyers continue to come in. They're fearful of missing out on a trade. Those of you that trade all the time know that there's obviously the market, a lot of what dictates what's going on is fear versus greed, right? Well, there's two types of fears. There's the fear of loss, which is the fear that most people, or is what most people associate with fear, but there's also a more insidious fear that affects traders possibly even more than the fear of loss, and that's the fear of missing out. And what happens a lot of times is traders do not want to miss out. You've seen the big move we've had all year. And so what they keep doing is keep chasing the price action higher because they don't want to miss out. And anytime the market gets towards all-time highs or just recent highs, you start to get this phenomenon where traders refuse to back down and keep piling in as we approach highs because they don't want to miss the next big move. And that's sort of what's happening here. You can see we're not really pulling back, and we just keep edging higher because new traders are coming in at the first signs of selling. This is usually not a good indicator of a potential move to the upside. More often than not, this resolves in a move to the downside, but it could continue to drift higher for quite a while before we finally get that resolution. So what I'd say right now is, if you're looking to trade to the long side and you're trading based off of what the market is doing, wait for resolution. It can occur when it comes back and tests the 20 period or this ascending trend line, or we could get a very narrow consolidation flag like this, and then we break out. And once we do break out, we're going to push towards highs. Now, I'm not interested in buying this breakout. And the reason I'm not interested in buying it is that there's very little left before we hit major resistance. And the risk reward to me is just not that appealing. Because even if we do break out, there's a decent chance that we come back and pull back and come back and test the 20, possibly the 50. So for me, this breakout is kind of a no-go. Not something I'm really that interested in buying. It's not something I'm really interested in trading too much. Now, if we pull back and test the 20 period, test this ascending trend line, then I think we got a little bit better shot here of getting some value as we make our way back to highs. Because at that point we have a clear stop and we have a clear move to the highs. Now, we also have potential horizontal resistance in this area, right? So even if we lose the 20 pair moving average and we lose this ascending trend line, we still have what has become now a nice little area of support, right? And you can see this aligns itself pretty well with what was a pretty strong level of resistance last year. And that is also a nice area to go ahead and buy the dip, right? So I think those are the three key levels we need to watch right now as we head into earnings season. If we have a poor earnings season and we start to see some real selling coming into the market, then likely the area that we're going to come to and test is this 280 area. As long as we stay above that area, I think things are still pretty bullish, despite the fact that we would have lost this pretty long-term trend. I think we'd still be okay as long as we held above 280. If we lost 280, well, then I think that introduces the potential for a downside all the way down to 262. I don't think it would happen right away. I think we have a lot of levels that would support price between here and there, but that would ultimately be the floor that we could reach if we finally have a big turn and a big change in character in the market. I think in the long term, we're probably going to head back there. I think we're still in what I would consider a broad consolidation range. This was an idea that I've posited at the very beginning of last year, that I thought we were going to spend the next couple of years trading sideways and mostly just mimicking what we did back in 2015 and 2016. You go and take a look at a nice long-term view of the market, and you can see that what happens a lot of times is you have these strong moves and they're followed by these neutral ranges where we just trade sideways. And when you're looking at it from this perspective, you realize that a couple of years trading sideways isn't really that big of a deal, and it isn't even that long. And so that's what ended up happening, right? We had this big move from 2012 to 2014. Then we traded sideways for a couple of years. And then in 2017, we finally broke out and traded pretty strongly to the upside again. And I think we're just at that same point now where we're reacting to that strong move we had from 2017 to 2018. And we're just consolidating and trading sideways. Now you can see we had a nice scare at the end of last year, and we did break down pretty strongly from that base. But we quickly came back into it this year. And I think at this point, you can see what we're doing here. And I think that we probably need another retest of this base before we try to break out or possibly break down again. Now, that is what I suspect will happen. But there's also, I think, a pretty decent chance that just like we broke down, I think there's a decent chance that we break out and push to new highs, and then possibly head back into the channel. And so what I'm watching for right now is how we react once we hit those all-time highs. I mentioned last week that every single time that this market has hit what's supposed to be a strong resistance area in 2019, it quickly just blew past it, right? So if we just rewind a bit and take a look at what we've done this year, you'll notice we started off the year. The first thing we did was we came up to this area here, this 258 area, which is a key, the sort of the bottom of that range that I just pointed out on the weekly chart. We spent 3 days, maybe 4, and then broke past it, right? And then we came up into this area around 263, which is another kind of potential area that maybe would have acted as strong resistance because it was the bottom of a channel that was kind of critical at the end of last year. And what do? We just pushed right past it, made our way right back up, and then we hit the top of that area. And what did we do? Well, we finally found some selling, but we eventually just pushed right through it and really didn't take that long testing it. And so now we've moved on, and we're making our way back to all-time highs. And again, the question becomes, what happens once we finally hit a real wall of resistance? Are we finally going to have stronger selling than these 4 candles, which is pretty much what we got out of the 280 area? Or are we finally going to have real selling that pushes the price action back and makes us forces us to sort of backtrack and retest some of these areas that we just blew past without really testing and seeing how much confirmation there really was at those price levels? So I think we're at a point right now where there's a little bit more uncertainty than you might expect just by looking at the markets. I think everything is pretty healthy. I still suspect that there's more bulls than bears and that we're still going higher, but I think we've reached a point where I'm getting a little bit more hesitant to go ahead and enter because I don't like the risk reward and I don't like where we stand as far as the big picture is concerned. So that's sort of my stance. Those are the levels that I'm watching on the S&P 500. We're going to see what happens with what the NASDAQ, the Dow Jones, and the Russell look like and whether they corroborate this and are painting sort of the same picture that we're seeing on the S&P 500. If we take a look at the NASDAQ, and you can see actually pretty close to all-time highs as well. The same general pattern, right, where we've got this really high and tight flag where sellers have made zero impact, and it looks like we're trying to push to new all-time highs. If we do falter here and pull back, well, I think there's a pretty key area, or pretty easy area to spot, which is this 178. We might just head to the 20 period and not even bother, but if we did come a little bit further back, I think this 178 area becomes a spot where I'd be a little bit more interested in playing to the long side, because we'd have much better risk reward at this area. If we lost that, I think we'd come down and test the 200 period, possibly this 172 to 170 area, and I think that would be a major area of support, and I would not expect us to really lose that in one shot. I think if we came down to that area, that would probably provide us with a strong bounce, and then from there, we'd see how we reacted off of that bounce and what the next move would be. But I think overall, at the moment, any drop I think is still a buy the dip opportunity. And despite the fact that I just pointed out on the S&P 500 that I think long term we probably need to head back to the bottom of the range, I think in the short to intermediate term we're nowhere near finding the selling pressure to really go through that. I think in the short term and intermediate term we're just looking for a pullback in order to buy that bounce as we head up and test all-time highs. I think at this point we're too close to all-time highs to not have them tested. So I think that ultimately we are going to head higher. It's just a matter of how that occurs and whether it's going to provide us with a good trading opportunity. Just because you think something's going to go up doesn't mean it's a good trade. Just because you think something's going to go down doesn't mean it's a bad trade or a good short trade. You still need the good risk reward and you need the high probability setup. And I think at the moment, despite the fact that I think the market wants to test all-time highs, I don't think we're in a spot here where there's a lot of good long opportunities at these levels. All right, so as far as the levels on the NASDAQ, well, like I mentioned, we've got 187 to 188 is all-time highs. I think if we hit them on the Qs, we're going to push past them. I don't think the Dow Jones or IWM, DIA or IWM are going to hit all-time highs or push past them. But I think if there's going to be an index out of these four that's going to push to new all-time highs, it will be the Qs. And the big tech names, I think, report in about a week and a half to 2 weeks, and that's probably going to coincide with when we really try to push past these. That being said, we could end. A lot of times the market anticipates a good or bad report and moves ahead of it. So keep an eye on this little flag pattern and watch it. I mean, it looks like it wants to push to new highs just in the next couple of days. And we'll see what the flavor of the FOMC minutes are, whether they have any kind of an impact on the market. And if not, I think a lot of it's going to depend on how we start tomorrow with the financials. And I think when Netflix reports, they're usually the first tech name to report. We'll see what occurs. Let's take a look real quick and see when Netflix reports, actually. I know we looked at it last week with Lana. She wanted to take a look at it, but got April 16th, so next Tuesday. Right, so we've got Netflix on Tuesday. Amazon's going to be the week after. Facebook's going to be the week after. Google's going to be a couple weeks after. And Apple, same thing, right? So that gives you a general idea of when these names are going to report and what kind of impact they're going to have in the market. So we're going to have Netflix next week, and then this week of the 22nd through the 26th is going to be a big one, and the week after as well. And that's going to obviously have a huge impact on the Qs. Whether the Qs make a run to all-time highs before those reports or not is still up for debate. I think there's a decent chance they do, but we'll see what happens. I think, again, these trend lines are going to tell us everything we need to know. If we lose this ascending trend line, there's a good chance we come back and test the 20. If we break out to the upside, well, obviously, we're just a stone's throw away from all-time highs, and that's going to be the spot we go to. If we do drop instead of going up, then, like I said before, I think 178 is a nice level to go ahead and buy the dip. If we drop even further and head down to 172 to 171, I still think that's a good area to buy the dip, although at that point I wouldn't be looking at all-time highs. I'd be looking at a bounce back probably to about 178 or so. Now, looking at the Dow Jones, you can see a little bit of a different picture, right? selling has come in on the Dow, and we did pull back these last few days, and you'll notice that the consolidation range is not quite the same. We don't have that same high and tight price action that we had on the S&P 500 and the Dow Jones. It's a little bit more of a sloppy sideways. I think overall this is still at the moment bullish, because what it's doing is attempting to sort of prove that it's breaking out above this 261 area. Let me get rid of this rectangle. And what we have here is this previous move here to about 261 to 262. And what we did right now is we broke past it, and we're in the process of retesting that breakout. So not quite as bullish as the S&P 500 and the NASDAQ that just kind of went past that level without caring. You'll notice again, this is this is basically around that level. You can see we came up and retested that a couple of weeks ago, and then just pushed past it on the S&P 500 and the NASDAQ. The Dow Jones, however, the first time it came up to that level, it didn't really push past it, right? And it came back and retested, and now it's above there. And what it's doing is it's trying to mimic that behavior just a couple of weeks later, where it breaks past the key level and is now in the process of retesting. As long as we hold above this, this is still pretty bullish and would still imply a move back to all-time highs. If the Dow Jones were to falter here and pull back, that would coincide with the S&P 500 and the NASDAQ coming back and testing their moving averages, and the Dow Jones would do the same thing. It'd come back and test the 20, more likely than not the 50. And at that point, I think what's important is that it sort of maintains this upward trajectory and doesn't come back and test this 252 area, the 200-period moving average. And as long as it does that, it's fine. Because, again, it's lagging. It's behaving a little bit more weakly than the other two, but it's still doing positive things, and it's still behaving in a constructive manner, and overall not really at a spot where I'd be worried about it. You're always going to have relative strength in one area or relative weakness in another, and I don't think at this point there's anything about the Dow Jones that concerns me or leads me to believe that there's anything to worry about as far as this market's concerned, other than the fact that the risk reward is just not great. And like I said, I think we're going to have a much clearer picture by the end of this month, when we have all those major tech names, all the FANG names report. So I think by April 30th, we should have a much clearer picture of whether we are going to push to new or through highs, or whether we're going to come back and have to test the bottom of that range as we head into the summer. For now, like I said, I think you should be looking upwards. You should not be looking down to the bottom. You should be looking at where these bounces are going to occur and how they're going to manifest, and see if they give us trading opportunities. This is the key area here, 252. As long as we're above there, things are bullish, and we can expect to at least trade sideways and possibly higher. If we lose that area, then I think that kind of tells us that there's a pretty good chance we're going to head back and test these 230s. So that's kind of the area that you really want to watch, is the 200-period moving average and this area right around 252 to 250. And then finally we have IWM in the small caps, and of course this has been the weakest by quite a wide margin. You can see all-time highs are nowhere near the price action and are not really a concern. I don't think we should anticipate hitting all-time highs with the small caps anytime soon. So the question becomes, what should we expect out of the small caps? You can see the price pattern so far is sort of doing this channel, this descending channel. The last few days we have flagged just like the other indices, but we haven't really been able to push past this. And I think at this point, if the other indices push to all-time highs, then we should expect IWM to clear this 160 and start to make its way upwards into this vacuum here. If the other indices pull back and test their moving averages, then I think IWM is going to come back and test this red trend line pretty quickly. I don't think the 20 and the 50 are going to make a difference here. And I think it's going to come back and test this 150 area. And I think we have to hope that it holds there and doesn't head down to the bottom of its range. Because if it doesn't, that's kind of a warning signal that traders are still pretty reluctant to accept risk and are still fearful of the market. And I think overall, again, something I've stressed the last few weeks and really over the last few years is this idea that IWM right now is the weakest of the four indices. It's been that way for quite a few years now, and I think a lot of traders are still even when the market is strong, there's still this element of fear or distrust in the market, and the manifestation of it, at least in my mind, has been this: anytime they're selling, the first place traders leave is the volatile and risky assets of the Russell 2000, and I think that continues. And as long as that continues, we can assume that the first place we're going to see signs of selling is IWM. Now, does that mean the small caps, if they lose these key levels, are going to drag the market down with it? No, that hasn't happened really over the last few years, and I don't think it's going to start happening now. But what it is it's a nice little warning signal telling us when there is more selling pressure, because it's the first place we see it show up is here. And that should tell us whether we need to rein in risk in the other indices or in any of our other holdings. But other than that, there's not much more we can glean from that. I think if you want to trade to the long side, I think you're still better sticking to the tech names, or areas that maybe aren't that correlated with what the markets are doing right now. Like I said, like oil names in the past, or even some gold names, which I suggested last week as well. And maybe sort of avoid some of these small cap names that are not in a great spot right now, and wait for better opportunities and a better setup. Now, if we get a breakout, then there is potential for some explosive move in IWM. So if you see the markets push and you see IWM break out of this and start entering this vacuum, then we might get a nice run in some of the small caps, particularly if people get excited about new all-time highs in the S&P and the NASDAQ. Then you might see the same thing come in where traders start to lose some of that fear and get more aggressive. And if that's the case, we could see a strong move into this big open area on IWM. So that would be how I'd want to get involved in any of the Russell 2000 names, is in a nice breakout here. And that might make more sense considering I said I don't like the risk reward on the S&P 500 or the NASDAQ. If they do break out and push the new all-time highs, then an area that might be worth looking at is some of these small caps that have lagged behind and have a lot more room to catch up and make up some times for lost time and lost ground. And so that's the four major markets. That's what I'm seeing right now. For me, particularly, I'm not that excited about trading to the long side. I'm not going to trade to the short side. So where does that leave me? Well, I'm going to be focused on earnings trades for the most part for the next 2 or 3 weeks. That's something I do every quarter. It's something that works very well for me. And I'm not going to be that focused on trading to the long side. If I do want to trade directionally, like I said, the best scenario might be a breakout where IWM tries to play catch-up. Other than that, I'm still going to look at a few oil names. I'm still going to post names on Patreon. Whatever trades I'm looking at, I'm still going to post on the patreon.com page. And I'll still give you an idea of what I'm looking at and what I think is worth watching. But generally speaking, I'm going to be more focused on earnings plays than on playing directionally. And, see what the market does, see how it reacts to earnings season, and then, see if we get a much clearer picture than what we're getting right now. Again, I don't think the picture is that muddy right now, but I think we're at a spot where the risk reward is not good, and we want to see a more solid consolidation range that gives us a better setup to play to the long side, or possibly even to the short side if something sets up. But I don't think at this point that's really a concern. All right, that's basically the markets in a nutshell and my thoughts on how I want to trade in the next month or so. Let's take a quick look at the US dollar. We're going to look at oil and silver and gold, and then we'll move on to the chart requests. I don't see any yet, but if you guys have any, feel free to type them in. We've got a good half hour to go over names you're looking at. Let me know if it's a name that you are. It doesn't even have to be a trade. It could be just a pattern that you're concerned with, or it could be a name you're in and you don't know whether you should take profits or whether you should stop out because maybe it's a loss. Just feel free to put anything in there just to have a little bit more discourse and a little bit more discussion on some charts. So here's the UUP index, which again is just the US dollar as an aggregate. The last couple of days we did pull back a bit, but overall the US dollar is still in a pretty bullish place as far as what we're seeing here. It looks like maybe it needs to come back and test the bottom of this channel before it continues climbing. But overall, I wouldn't really say anything is negative on this in the intermediate to long term. In the short term, it has been sort of pulling back slightly, and the question becomes, when is it ready to sort of finish this bull flag and move higher, or come back and test the bottom of this channel? Now, what we're seeing here in the euro, again, this is a pretty important chart right now. you can see the euro has gained over the last 3 days on the US dollar, and that's kind of what leads to that little descending flag. Remember, this is going to be inverse because it's priced in euros. But overall, I think that this chart still is actually pretty bullish for the US dollar because it looks like the euro is going to encounter some stiff resistance here, and this could be the final straw in this big battle over this 113 to 114 area. And if the euro cannot climb through this descending trend line, we're going to color it red because I think at this point it's pretty significant. If the euro can't get past that, I think that we're going to look at a pretty big rally from the US dollar and a big drop from the euro as it drops back and continues to sort of lose this level. I think price action has eroded pretty strongly on it. You can see, you just sort of step back and take a look at it. And we're going to go to the weekly chart for this. You see what's happened recently. It kind of pulled back, and then you can see it tried to hold above 114, failed, came back. Now it's trying to reclaim that 114 and failing, and starting to inch a little bit lower. And if it can't break this pattern and start to make its way back up through that area, well, the next step is to come all the way down and test way down here around 109, 108. Not even 110, but just even lower. Again, that's a pretty critical zone. This was a major area of contention for the euro and the US dollar, and ultimately became the spot where it really broke out and headed way back all the way up to the 125s. And it's right back in this area, and it's really struggling. Now, it's not done, right? Even though it looks like it is, there's a decent chance that it can break this and really rally and then sort of make this entire thing this one big retest that worked. But if it continues to fail here, then it's going to head down and it's going to start testing a lot lower. And I think that's going to bode well for the US dollar if it does, or poorly if we do get that breakout. But I think if you're looking for the US dollar, if you're worried about what's going to happen with it, how it's going to affect gold and silver, this is the chart you want to watch. And the points you want to watch right now is this red trend line, and if it breaks past it, this 113.18, 113.80 area or so. Those are the two major areas you want to watch if you're looking at the US dollar or anything that's affected by the US dollar. Now, we do have the US, if I can type correctly, the US versus the Canadian. And I think overall, again, this is still a pretty bullish chart. Until it loses 133, it's a bullish chart. If it loses 133, then we're going to probably head down to test this 131 area, 132, and yeah, 132 to 131.80. But until it loses that, we can assume that it's going to come up and test the top of this and continue working on this consolidation pattern, which could ultimately resolve in a move back towards these highs around 136, 135, 136. That's still, I think, a ways away, but that's what we want to be watching. And then the US dollar versus the yen is actually a little bit different. And at the moment is in something of a bearish pattern, where we had this nice trend, then we had the break, and we came up and retested that break. Now, it did inch past it, which was hinting at the possibility of a bullish move, but ultimately it did roll over. And at this point, this looks sort of like a bearish move. And we'll see whether this manifests in a move all the way back to lows or whether it starts to chop around and is saved a little bit by the bullishness in the US dollar from the other areas. I think overall of the three, this is the one that looks the most, that gives us the most warning that it's possible the US dollar could struggle here. Now, this could be just due to Japanese yen strength and not necessarily dollar weakness. But overall, this is the one pattern that's not showing the potential for a bullish move. And we'll see what happens. If the euro ends up gaining ground, then this is likely going to mean that the yen makes a move all the way down to 109 and possibly even lower. So, that being said, I think it's a little bit of a mixed bag right now with the US dollar. I think that there's the potential for a bullish move, but it's not there yet. And until it occurs, there's always a chance that we continue to see more selling off. And if that's the case, then we'll see gold and silver continue to climb. I mentioned last week that it actually looked like a decent spot to buy off of this consolidation pattern at support. And it had a very nice move, this nice 3-day move, and is making its way back towards this 124 to 125 area. I think that there's a little bit left in this, but if you didn't enter or you didn't try to trade this to the long side, I think you're a little bit too late to the game. And at this point, you just want to watch. SLV had the same sort of move, not quite as strong, but overall, again, did a good job of confirming support at a key area around $14 on SLV. And I think of the two, I still prefer gold. I've preferred gold for the last year or so, and I think it's still the area. If you want to trade precious metals, you're better off sticking to GLD and to some of these gold-related names, some of the gold miners, as they try to mimic this and follow behind it. At this point, it's probably worthwhile to take partial profits and then hold for a little bit further. I wouldn't expect them to move back to 127 or beyond at this point. I think it's still just sort of testing and trading sideways. And you can see it's a pretty sloppy range, but overall it's just trading sideways. And the fact that, if you caught the bottom, you should be looking at taking some profits here and then holding for the top of the range, but making sure you don't get caught with nothing in your hands if it comes back and heads back to the lows, which could happen pretty quickly if the U.S. dollar has a nice move versus the euro. All right, and then finally we have oil, and oil continues to be strong. Those of you that are regulars here know that I recommended going long oil or oil names back here when it had this nice consolidation, and you can see it had a nice breakout and a retest of this range and was able to push past it, and it's done a really good job of climbing pretty steadily, has accelerated, which is usually not a good sign because a lot of times it shows that there's going to be exhaustion coming soon, but that's not the case right now. It continues to do well, and until it changes character, I think it bodes well to go ahead and follow it to the long side. Now, where can oil head from here? Well, I think it's already heading towards the first major area that it needs to get to, which is the 65 to 66 area, which is right where it's at right now. You can see this area right here, which was 66, is kind of a key area, and we're pretty close to there. And I think once we hit that area, we should encounter some resistance on oil, at which point it would make a good idea to take some profits if you were into a name like this, or a trade like this, or some of the names related to it. But overall, there's still a little bit more upside on it, and it's not really doing anything to doubt it. So at this point, I wouldn't get too caught up in trying to play the other side of this trade. So when I mention stuff like this, right, and I say oil-related names, and what I like to do in these sorts of things is, for those of you that follow me on Patreon, that are members, you'll know that I recommended a trade on, say, Chesapeake for one, right? You can see what we were doing on it, and you can see it had a nice breakout. Now, it hasn't been a major move, but it's done pretty good. 25, 30 cents on a $3 name is actually pretty good. That's still almost 10%, and 10% if you got the whole 3% on it, which is a pretty big move in just a matter of 3 or 4 days. And stuff like this, or maybe like Patterson, you're getting nice moves on some of these oil names, and I think there's others that haven't really followed suit yet. But this is what I generally mean when I say, look for names related to it, look for patterns that are mimicking it. You can see pretty clearly, say on this one on Patterson, where it's sort of traded similar to oil, not quite the same, but we've had this channel, and it's been sort of climbing upwards around it. And you can find a lot of patterns that mimic these, whether you're looking at the gold miners, whether you're looking at oil names, or even if you're looking at tech names, right? So, for instance, another thing I mentioned last week was that I like tech as far as related strength, right? So you look at Amazon, and it's doing pretty much what the NASDAQ is doing, right? It had this nice range, and it broke out, and it's had a nice little move from 1780 to 1848. So a pretty nice move. It may not look like a lot on the chart, but it's actually a pretty good move if you had traded it. And this is the idea, and this is what I try to point out whenever we go over the markets. It's not necessarily to trade the S&P 500. It's not necessarily to trade oil futures. It's to find areas or sectors of the market that are benefiting from what we're analyzing in the overall markets, and then going ahead and trying to take advantage of those and trading the individual names that are giving us patterns very similar to what we're seeing in the overall markets. And so that's what I've been looking at, and that's what I've been doing over the course of the last couple of weeks. Well, we still don't have any chart requests. We don't really have anything else to talk about. So I'd love to see what you guys are looking at. I'm going to go ahead. What was this? So here's a gold name, again, that's mimicking what we're seeing on gold. This is one of the ones that I like to go to quite a bit, Kinross. And you can see, again, same thing, right? We had this nice pattern. You'll notice it's behaving a little bit better, but it was the same idea that we saw out of GLD, right? So you see GLD, we had this nice range. We had this nice consolidation range at support. And that's really what KGC was doing, only it's been more bullish. And instead of a horizontal base, it's been slowly climbing higher. We had that same sort of consolidation, and then we had the nice breakout. And again, it may not look like a lot, 20 cents, but that's 20 cents on a $3 name, which is actually not bad, with the potential for further as it tries to push past this. Okay? So that's just to give you a general idea of how I use the information that we come up with in these Wednesday webinars, and what I'm looking to do and how I want to go ahead and take advantage of the information I'm giving you guys is you find an area that looks strong or looks like it has a potential move coming, and then you look for patterns that give you good risk reward and give you a nice healthy trade setup, and you go ahead and you take advantage of that and trade that rather than just following the market long as it approaches highs. Okay? Right. That pretty much covers it, I guess, if no one has a chart request. Scott, you have a question about Frank, and I wish I had an update for you, but I don't. I have not been able to reach the family. I imagine that this is a stressful time for them, and at the moment they're just dealing with him, and I haven't gotten an update in the last couple of weeks. I know he's stabilized, and he's doing a little bit better. For those that maybe don't know, Frank had a stroke, I guess, about a month and a half ago, and I guess he's still dealing with complications from it, but I don't know. I haven't heard from him, and I haven't heard from his family, so I have to assume that he may be doing better, but obviously not good enough to be able to talk or to communicate with others. So that's all I know. Okay? And I guess we'll call it a day here since no one has any chart requests today. Keep an eye on earnings season. Keep an eye on what's going to happen as we start to hit earnings. And like I said before, a word of advice. If you're looking to swing trade, make sure that you don't go into a name and not pay attention to what the earnings date is. That's pretty important and could have a significant impact. Like I said, if you go ahead and take a look, say Netflix, right? You look at the moves that it has, it can move 15, 20% from one day to the next. And if you don't anticipate that in your trade, then it could have a significant impact on you could end up blowing out a pretty good chunk of your account, not expecting a 20% move. And I know over the last few quarters it hasn't had that, but in its history, Netflix has had plenty of 20, 15, 20% moves. And there's a potential for that on any name, not just Netflix. So keep an eye on that and make sure you pay attention to earnings, and don't let yourself get blindsided by a report that you weren't ready for. Okay? Sure, Mike, if you want. Are you on Discord? All right, well, let me close out the video first. All right, guys, so thank you once again. Those of you on YouTube, feel free to watch, and if you have any questions, you can always ask me on Twitter, or you can ask me on Discord, or you can email me. Other than that, hope you guys have a good rest of the week, and we'll meet again next Wednesday.